We begin, though, with a moment of truth for the markets. We are just hours away from earnings season kicking off in a big way with results from Citi, Goldman, JP Morgan Chase, and Wells Fargo all out before tomorrow's opening bell. So will the banks be the bellwether for the markets as we head into the rest of earnings season? Guy Adami.
I don't know if they're the bellwether, Mel. And I'm a little tired, as you know, because late night for us Yankee fans.
Oh, yeah, it was
Tim
a
is
late
not
night.
Steve happens.
I'm a New York fan. Go Yankees. But let's talk markets.
Sorry, we did what we needed to do in Houston, as you know, Mel. But it comes to me, it's not the bellwether, but are there trading opportunities? And I still think there are. I mean, Citibank to me was an interesting play a couple weeks ago. It proved to be correct. But tangible book and Cities are coming around $69. I think what you'll see is a bounce after earnings on the back of that. It trades anywhere from 85% of tangible book to 1.2. And I think that's what's going to happen now. But in terms of a bellwether for the broader market, I don't believe that to be the case.
I think it's about positioning. We've all talked about that. And I think positioning has been negative in the financials. I've been negative in the financials. But I do believe estimates have come in enough that you can sort of walk over them. So I think you're going to have a tradable bounce in the financials, but longer term, I would not be there.
You've been positive on some financials.
I've been positive on the banks, and it's hard to go into the third quarter. As Steve says, I think the expectations have certainly been adjusted. You're going to have mildly weaker loan growth. People are going to be looking at net interest margins. I will say, for all the heat the banks have taken, net interest margins before the last two quarters, and I realize it's back, but we're at 6-year highs. So banks weren't getting credit for profitability that was inherent, and yet they were giving you record profits. So I don't think these are going to be terrible numbers. What I would be most worried about, especially we're talking about a barometer for the economy,
sure.
I want to look at what they're doing in terms of loan reserves. I want to see what these guys are putting aside. Has the world really gotten that much worse? They know. And I think people want to hear that right now. I don't think it has. But that's the read on banks right now if we're supposed to be at the crossroads of the economy.
Yeah, what are they saying about credit, delinquencies?
Right, and all
like
that's at record lows because you don't do it until it starts raining. But what we know is that this is an area of the market that's basically, on a relative basis, not paid for the risk embraced by being there. Just to consider this, going into the year, consensus was that the big banks would have another $15 billion in revenue this year. It's going to end up being only $2 billion. Now, what cuts the other way is, of course, they're unleashing their buybacks, right? They've got approval from the Fed, so it's all going to be about cost cutting, right? And that really is what we've got to look for if one's hopeful.
And the sweet spot is housing. So it's the same type of thing where you have mortgage originations, then you have refinancing. How long does that last? How much of a boon is that going to be for the financials? And I think that getting back to the positioning, if people are on one side of the boat, this market has surprised a lot more people.
To Carter's point, though, I mean, Bespoke tweeted this out. That in the 9 past quarters, Morgan Stanley traded down on the day of earnings every single time, no matter what they did with their earnings.
Well,
good, bad, they traded lower. What does that tell you then?
It tells me that Morgan Stanley's probably in businesses where their margins are just been getting cut every single quarter. I mean, it's harder and harder for Morgan Stanley and at Goldman Sachs, for that matter, to make money. I think that's what you're seeing to answer that question. But in terms of Citi and JP Morgan, listen, the reason why I think Citi is interesting is because it vacillates, as I mentioned earlier. So tangible book and Citi will come in around $69 tomorrow, give or take. 1.1 times tangible book was sort of it's where it's traded on their upper end. That's a $75 stock. Go back to this time last year, and that's where it topped out at, which is what I think is going to happen again tomorrow. JP Morgan, which everybody says is the best bank, they are, but they're rewarded in terms of valuation. So you're approaching almost 2 times tangible book in JP Morgan. At a certain point, that just becomes too expensive, in my opinion.
And JP Morgan, and Carter's going to give me some, we've had a little spat about this because it's true. I can pick JP Morgan's chart and say, not that bad of a chart, right? It's actually outperformed the S&P by a little bit over the last 2 years, even though it's not representative of all of them. And so guys talking about Morgan Stanley, Goldman Sachs, look, asset managers, and it's really as much Morgan Stanley as anybody, asset managers are seeing massive compression in terms of everything that they do in terms of commissions and in terms of their market share. And so I don't think you're going to see great numbers out of Morgan Stanley. The flip side of all this, and for money center banks and even for Morgan Stanley on the capital market side, with record low rates again, you saw a lot of folks rushing to refinance in the corporate bond market and the issuance bond market. I think you're going to continue to see pretty good momentum into the fourth quarter, and I think they're going to guide to that. And mortgage, and Steve talked about housing. I mean, look, that all very good for a mortgage business that was largely dead in the first half of the year when rates were going a lot higher. So I don't think it's a terrible story. I just think it's not an extraordinary story.
For part of this quarter, though, we had inversion of the yield curve until basically a week ago. So how do you think that manifests itself in the earnings?
I think that's not yet sort of a case for good or bad. I think you have to say this. The objective all the time is to try to find something that's about to get exciting, break out or break down, to get long, get short. it belies that sometimes things are fallow. We've talked about this.
I love that word, fallow.
The banks are probably not going to do anything.
We don't use it enough on the show.
We really don't.
Not going to collapse.
Can we define fellow, Carden? Yeah, I feel like I'm a fellow. Am I a fellow?
You're a good fellow.
Hey, forget about it.
Hey, forget about it. So, I mean, why can't it be that it can't? Not everything is directional all the time. Sometimes things just are where they belong, and banks are kind of in that spot.
By the way, Carter's tie. You know, is the season.
I know that because that's what you say about this particular tie every single time Carter wears it, no matter what the season.
Well, he doesn't wear it all the time. I mean, he just happens to be wearing it on a day that feels a lot like fall.
I thought of you.
I mean, to sort of tie a ribbon on this. Go ahead. What were you going to say?
I've got a chance to do that. I mean, look, it's fall earnings season. This is what we're talking. It's about time we got into real bottom up in terms of all we do is talk about trade wars. All we do is talk about the top down. All we do is talk about the Fed. Let's get at it. Carter's tie tells us it's time for fourth quarter guidance as we get into third quarter or the fall.
And people have been tremendously negative on all of those fronts on the macro. So this might be a good respite to start and looking for fundamentals.
A lucky
and
tie.
look and get thick and get deep. And if they surprise, which I do think they will as a whole, earnings that is, I think the market can drift.
Well, it doesn't hurt that estimates have been coming down, particularly for financials going into this season.
So you might have a bit of a. Watch this.
What?
Crop rotation. See what I did there, Carter?
Wow.
So,
in terms of
I might not
banks,
recover.
You might have, but again, I think it's going to be short-lived. Again, I think Citi to 76, maybe J.P. Morgan to 120, and then those things get sort of ahead of their skis.
Well, that's just it. Do you go best in class, J.P. Morgan, which is full, perhaps valuation, or do you double back and find a dud like Wells Fargo that's been lagging and play it for catch-up? Both techniques are valid.
I don't think Wells Fargo is a name that you're going to see re-rate anytime soon. I think there's still so much lack of trust.
The new CEO in place.
I think there's still a lot of work to do there. But I think the other side of J.P. Morgan historically in the last 5 years has been Citibank in terms of the quality. And I think when Citibank, you really have a valuation argument. And I think they have a fair amount of leverage in some global businesses that they're one of the first banks to really sell off in the third quarter based upon what we were seeing around the world. If you think that a lot of people talk about stabilization here, I go back to macro. But if you think that PMIs and whatnot have actually started to stabilize, Citibank over J.P. Morgan is a better trade.